trading forex. Will never need no record deal. Making my own investment. Market printing me money. Peace, guys. Welcome back to ZENSFXHUB. I know it's been a minute since I dropped the video, but what better way to get back into doing content than to give you guys my 2026 outlook. Don't want to make this video too short, so we're going to go ahead and jump right in, okay? So the key points. 2026 is decided by inflation and labor, not politics or headlines. And the reason why I say this is because a couple of times this year I got burned based off things that were coming out on Twitter and stuff like that, and I kind of lost track on the main important thing, which is looking at the actual macroeconomics, the data, okay? So I don't want to go into 2026 making the same mistakes, and I don't want you to do the same. So we have to ask ourselves this question. Can financial conditions ease without inflation re-accelerating? And we're going to talk about that, right? If the answer is yes, risk assets will perform well, USD will weaken, and gold will continue to trade higher, get into that $5,000 ounce that everybody's keep on predicting, right? If no, USD will strengthen and gold becomes protection. And we'll talk a little bit of what that means later on when I jump into the scenarios, okay? So we're going to look at two things, right? The two most important things going into next year is inflation, okay, and labor. So we're going to talk about inflation. Ignore the headlines regarding CPI and only focus on core CPI, core PCE, and service inflations, okay? Core CPI is consumer prices excluding food and energy. So this is a fast-moving headline. So this is why a lot of people like to trade it, okay? Core PCE, the Fed uses to make rate decisions. It ignores food and energy because those prices jump around a lot and can cause fake panic. It adjusts for how people actually behave when prices change. Okay, so look at core PCE as the Fed measurement to be able to determine rate hikes, rate cuts, or pauses. Okay, service inflation. This is inflation. This is inflation in sectors like healthcare, education, transport. Reveals the truth about inflation pressure because it makes up of 57% of the consumer price index. That is more than half. Okay, so that's a lot, right? So to put it all together, core CPI tells us what happened, core PCE tells us what the Fed believe and what they're gonna do when in regards of rates, and service inflation is the truth. If services aren't cooling, then everything else is noise. Why? Because it makes up 57% of the consumer price index. Okay, so I also want to add in here for you guys. You probably like, oh, where do I get this information? I'm going to show you right now. So literally, it's super simple, right? So you come to this website called Trading Economics. This is one of my favorite websites. I use this every single day. Okay, you're going to click on countries. You're going to come to United States. Okay, and at the top, you're going to have a bunch of different things that you can click on. Okay, so when it comes to prices, as you can see, you see the core PCE, you see energy inflation, you see everything, every service inflation, everything that I mentioned in that video is in here. So you come to this website, click on countries, United States, click on prices, and you'll get all that information, okay? So the key levels we want to look at when it comes to core PCE, right, inflation, is we want it to be 2.5% and dropping. We want it to come down, right? Because this will allow us to know, okay, this will allow the Fed to continue to do rate cuts, which is what they want to do, which is what Trump wants the Fed to do, rate cuts. If core PCE is stalling or moving higher, then rate cuts might be halted, and then it depends on how long that's happening, then we might see them actually implement rate hikes, okay? But as of right now, the direction we're headed towards is rate cuts, okay? So the impact this is going to have on the market, right? Cooling inflation coming down will cause the U.S. dollar to go down and will trend higher. Sticky inflation or inflation going higher or at a standstill will cause the U.S. dollar to rise, and gold will chop around, having a later breakout. And the reason why the U.S. dollar will rise is because rate cuts hurts the U.S. dollar. But if they're not doing rate cuts, then it actually gives U.S. strength, okay? So this is what I want you guys to pay attention to when it comes to inflation, all right? Now, number two, the labor market. Labor determines whether inflation stays down and whether the Fed can cut, okay? So the things that truly matter is what we want to pay attention to from a quarterly standpoint is unemployment rate, wage growth year over year, average hourly earnings, and NFP revisions, okay? So paying attention to those four things quarterly from a macro standpoint will allow you to see just how well or bad the labor market is doing. Okay, so this is what the Fed wants when it comes to the labor market. They want they want unemployment to slightly push higher. They want it to go higher little by little by little. Okay, they want wage growth to drop slowly and steadily, and they want hiring to cool but not collapsing. And the reason why they want this is because this will allow them to be able to move forward with their decisions to do rate cuts. Okay, so I put together 4 scenarios that can happen going into 2026 depending on inflation in the labor market. Okay, and we're going to go ahead and talk about that right now. Scenario A, a soft landing, what most traders want. What these conditions look like: inflation falling, labor market slowly dropping, wages is cooling, right? US dollar will go down, gold would continue to trade higher, and equities, stocks have a control rally. Okay, so this is what we want going into 2026. This is what's going to allow gold to get to that $5,000 an ounce price. This is what allow us to be able to see the Fed do rate cuts. And if you are ready and you are aware of this, and you trade things like EU or USD/JPY, USD CAD, this is what's going to help you be able to get in for those nice, beautiful trades and just swing, hold. You know what I'm saying? So this is what we want. Okay. Now, scenario B, we go into a recession. The conditions that this look like when it comes to inflation is falling, but the labor market is breaking too fast, meaning unemployment rate is going up at a fast pace. Everything is just going fast. Like the labor market is breaking, and it's causing a lot of panic and chaos, right? This will cause gold to explode. USD will go up in the short term, but later will have a crazy drop. The Fed is forced into aggressive cuts, and equities have a sharp drop. And the reason why gold will explode, because you got to remember, gold is a safe haven. Gold moves of chaos and uncertainty. And if things are going to hell in the United States, people aren't working, people aren't making money, then gold is going to just, you know what I'm saying, out of here. And the reason why the US dollar will go up in the short term is because the reason why the US dollar will go up in the short term or later drop is because, again, this is, if the economy is breaking too fast and the people within the United States are hurting bad, then that is not good for the United States. Okay, so that will have a huge effect on the US dollar. Okay, and obviously the stock market would drop insane because there will be a lot of people getting fired. A lot of people, none of these companies like within the NAS and like NAS 100, US 30, like these top 100, these top 30s, these top 500 companies, it will be a lot of layoffs. They have to let a lot of people go. They won't be hiring. They won't be making no money. So this is like a ripple effect. Okay. Scenario C, the Fed is trapped. So we have inflation sticky, meaning it's not moving or it's going up. The labor market is remaining strong. So the US dollar will be strong. Gold will chop around. Equities will range or have a sell-off, and yields will move higher. And the reason why the Fed is trapped is because, again, in order for them to move forward with doing rate cuts, the labor market has to be, it has to be cooling, coming down. And inflation has to be coming down as well. But if inflation is not moving and the labor market is strong, then it's like, okay, what do we do? It's like a damn if you do, damn if you don't kind of situation. So they'll be trapped, and they'll have to wait for the data to come out piece by piece in order for them to be able to make a decision on whether to do rate cuts or pause. Okay. Scenario D is stagflation. So we have sticky inflation and we have the labor market weakening, right? Gold and other commodities will move to the upside. USD will be volatile and have no real trend, and equities will be lower. So inflation stays sticky while the labor market is weakening. This will cause the dollar to not really have, again, no real trend. So it will, one week we might be shooting up, the next week we might be shooting down. It might be just be range based. Okay. So these are the 4 scenarios that can happen going into next year, and depending on the data that we get from inflation and from the labor market, when we put them together, this will allow us to see, okay, where are we headed and what markets, what should I be doing in these markets, okay? So, political narrative versus market reality, okay? So, Trump is already said that he feels like 2026 is going to be a great year for America. He's very optimistic about it, right? So that's the political narrative that is being pushed right now. But the reality of it is, if inflation isn't cooling, if wages are slowing. I mean, if inflation is falling and wages are slow, labor market is weakening, and the Fed continues their direction of doing rate cuts, then that's where we'll have the optimistic outlook when it comes to 2026. But if these things don't happen, then all that shit is out the window. Okay. So the things I want you to take away from what I just mentioned is trade the data reaction, not the speeches, not the crazy tweets and headlines. Okay. Look at the data: inflation, labor market data, okay, and put them together. Though these are all the pieces you need to make the big picture. Most of 2026 will be about positioning and patience, not constant trading. Okay, so inflation decides the path, labor confirms it, and then the price tells the truth. So whatever we get from inflation and the labor market, we take that and we bring it to the charts, and we have we have that confidence when we press buy and sell, depending on what's going on. Some other things that I wanted to mention before I wrap this video up is I trade the yen, I trade the euro, and I also trade the Canadian dollar. So I wanted to mention this, right? So Japan is the most important wild card going into 2026 because of its policy divergence. So Japan is the only country right now that's doing rate hikes. Okay, so when you put that together, right, when you have the BOJ, the Bank of Japan hiking, and you have the Fed cutting, and you put those two together, you might see some downside for USDJPY. So you can actually get in for sales on USDJPY because you have one that's doing cuts and one that's doing hikes. And if you don't know what rate hikes and rate cuts mean, I have a video where I explain all this in simple terms for you to understand it. So make sure you go watch that and then come back to this video so it can all make sense. If the Fed decides to hold doing rate cuts and Japan changes its tone about doing rate hikes, then we'll see the opposite. We'll see USDJPY actually move to the upside, okay? So something to keep in mind. And then the Eurozone, right? Euro just pretty much confirms whether what the US is doing, it just confirms if it's temporary or if it's something that's like real, right? Actual, okay? And the way we see this, right? So right now, the ECB is not doing, they're not cutting at all, right? They've been stopped doing a rate cut. Inflation is down at the level they wanted it to come down to, so they're chilling right now. And if you have the Fed doing rate cuts, right, then we'll see EU trade higher because we have one country that's lowering their interest rates and we have another country that's not lowering their interest rates and they're just chilling, right? So we'll see EU trade higher. But if we got the Fed and both the Fed and ECB not doing no rate decisions and they at a standstill, at a halt, then we might see EU just be range bound, bouncing between two levels. Okay, so paying attention to the Eurozone just pretty much confirms or invalidates the US weakness. Last but not least, Canada, right? Canada acts as a proxy for global demand and commodity driven inflation. So the key things when it comes to Canada is the oil prices, right? So if you take the oil prices and then you take the US growth conditions, whether meaning inflation and labor, and you put those together, that will let you know whether you can see some strength or weakness coming from Canada, right? So we have strong oil prices and USD weakness. Canada will perform better than the United States, and then you can take that and trade USD CAD with it if you want. And then if you have weak growth and then you also have oil prices dropping, then Canada might underperform compared to the US. Okay, so then you can make your decision based on that. All right, so going into 2026, make sure you pay attention to everything from a macro standpoint, and this will allow you to be able to make a decision. Not even make a decision, but this will allow you to be able to see what scenario is playing out for you to make a decision on being on the right side of the markets. Okay, so I want you to come back to this video and use it as like a cheat sheet. Okay, and I trust that you have a great trading year, and I look forward to continuing doing these videos, and I look forward to growing my community and connecting with you guys. If you have any questions, comments, or concerns, let me know down in the comments, or you can send me an email at ZENSFXHUB@gmail.com. All right, so I'll see you guys in another video. Peace.